Doobity-doo. Good morning. Morning, Chris. Morning, Jane. Morning, John. Morning, Leo. Morning, Nicola. As usual, if you have just joined, if you could mute, please, that would be excellent to allow Anu to speak. Thank you for muting. Thank you very much. John, if you could mute, that would be great as well. Thank you very much. And there's more people coming in. Morning, Mike. Morning, Sophie. Morning, Ian. Thank you for joining. Thank you for joining. If you've just joined, if you could please mute just to cut out any background noise, that would be great.
With apologies, I just wanted to let you know that I've got to jump off for a meeting at 11, but I didn't want to appear rude.
Not at all. Stay as long as you can. Stay as long as you can. That's
Thank
lovely.
you.
Thank you. Yeah. And morning, Billy. Good to see you. Morning, Peter. Morning, Andrew. So yeah, mute. Ian, if you could mute as well, please, or I can mute for you. Thank you. And John, thank you for that, John. Brilliant. Okay, and Podreg's coming in as well. Morning, Podreg. Morning, Catherine. Thanks for joining. Thanks for joining. Okay, I think we're nearly there. Yeah. Okay. Perfect. Okay, well, good morning, everybody. Welcome to this week's Coffee Morning Pension Playpen. We're delighted to have Professor Basu. He needs fine to be called Anup, so we can all call him Anup, which is very nice. Thank you very much. Anup is dialing in from Boston, so where I think it's at 5:30 in the morning. So we should be gentle with him, I think, on this occasion. So he's got I'll let him introduce himself, obviously. We are now recording, so can I see thumbs up for everybody that everybody's happy to be recorded? Thank you very much. Thank you very much. So we're now being recorded. I will monitor the lobby, and as usual with the Coffee Morning, if you want to make a point or ask a question of Anup, then please raise a hand. We will also open the chat as well. Yeah, please be as interactive as you'd like. So without any further ado, I will pass over to Anup. So Anup, over to you, and good morning.
Good morning. Early morning in Boston, and thanks everybody for joining in. My name is Anup Basu. I'm a professor of economics and finance at Queensland University of Technology in Australia, but currently I'm a visiting academic at MIT in Boston. So without much ado, I will start with the topic today, which is Australian retirement system. So I'll talk a little bit about the system itself and what's going right for the system and how basically we can improve the system going forward. So, okay, so it's generally a three-pillar system, as you know, in Australia. It is hailed as a kind of public policy success by a lot of people. Although there has been some criticism about the system being too prescriptive or paternalistic in the accumulation phase and too flexible in the decumulation phase. So the system itself is kind of well known, the three-pillar system, which is observed in other developed economies as well. You have an age pension, then an employment-based superannuation, and private savings. I will focus mainly on the age pension and the superannuation part, and mainly the superannuation. With private savings, obviously, it is very variable between individuals. There's one common theme, though, that among private savings in Australia, retirees have a very high percentage of ownership. I think it's near about 85% home ownership of retirees. And of course, some retirees do downsize at some point of time and release the equity in homes to pay for their aged care facilities when they're ready to move in. But I will start with the age pension. Age pension in Australia has been prevalent since 1908. In its current form, the age pension is universal pension, which is quite distinguishing characteristics of Australian age pension, as opposed to something what we see in US, Social Security, where you need to make contributions. In Australia, you don't need to make any contributions to be getting an age pension. So any Australian above 67 years currently in age is eligible to get the age pension. So they don't need to work, they don't need to contribute in taxes or like a national insurance contribution in Britain. So everybody can be eligible for an age pension, irrespective of whether they have contributed or in taxes or not. The age pension is generally it's paid from the general tax revenue. So there is no separate account for age pension like Social Security in the US. So that's a kind of distinguishing feature. And also it is means tested. So the age pension is not a flat pension for everyone in Australia. So again, it's a kind of different from what I see here in the US. In Social Security, so everybody gets a flat rate of Social Security. So so basically, you may or may not get age pension based on your assets and your income. So if you get a age pension, the full rate of age pension is close to $43,000 per year. But to qualify for that $43,000 per year for a couple, if you're looking at an individual, that will be about 2/3 of that amount. So kind of $28,000 Australian dollars per year. But for being eligible to get the full age pension, your income has to be less than $9,360 per year. And your assets, again, I'm talking about couples, your assets have to be less than $451,500 if you're a homeowner, or $693,500 if you are not owning your home. Now, this asset test does not include your family home. So it's only the financial assets you have outside your own family home. So if you qualify for that, then you get the full age pension. Otherwise, you will probably get a part age pension if your income or assets are above that level. But you won't get any pension if your income exceeds $95,336 per year for a couple. Again, for an individual, that will be 2/3 of that amount. And if your assets are more than $1 million as a homeowner or $1.2 million as a non-homeowner, your family home excluded from that calculation. So basically, in between, so a lot of people will be getting part pensions as well. So full age pension only for people who qualify that means test in terms of their income and assets. So the next one is, of course, the mandatory superannuation contribution. Now, this is employment-based occupational scheme. So, and it is, again, the unique feature is it is compulsory. So there is nothing optional. The contributions are made by the employer at a certain rate. This mandatory nature of the superannuation system is unique, so you don't have any opt-in or opt-out provision here. So the superannuation guarantee, the legislation came into effect in 1992. So when it was made compulsory for everyone. And at that time, the contribution rate was only 3%. So it was gradually increased to 9% in 2003. And after that, it remained at 9% for more than a decade, up to 2013. And since 2013, it has again started increasing. And now currently it is 11% of gross employment earnings, which every employer has to contribute in the employee's superannuation account. And again, next year it is going to increase to 11.5%, and then it will be 12% from 1st July 2025. So and I believe that it will stay at 12% for a very long time. And I don't see any appetite for increasing that amount. And in fact, there has been some talk about the 12% rate being pretty high. So that's the compulsory superannuation. And then in Australia, as you would know, that most plans are, or most superannuation accounts are currently defined contribution in nature. So you hardly see any employers coming up with new defined benefit plans. So currently the statistics is 97% of all superannuation accounts are in defined contribution or accumulation, as they call in Australia. And there are 3% defined benefit. In terms of assets, roughly it is the same. So 94.6, that's the kind of division. So defined contribution or accumulation plans generally offer you a choice of investment options, and every superannuation fund will offer you that kind of choice. If you do not make an active choice, your money is generally parked in something which is called a default investment option, which is a common feature in every country. It's a trustee nominated option. And then otherwise you make an active choice and pick up another investment choice from the menu of choices offered to you by the superannuation fund. So I remember in the last 2 decades, the number of accounts in default options has reduced. So for example, probably around 2005, it was around 80% of accounts were default investment options accounts. But now it is down to 66%. That means more people are now making active choices or engaging with their superannuation more. In terms of assets, actually, the choice accounts now have 55% of the total assets, and 45% of superannuation money is in the default options. It's also called MySuper. Most of the default options are called MySuper in Australia, which is a kind of no frills kind of option with low expenses, a balanced option. So just looking at some of the statistics, and this is published by the Australian Prudential Regulation Authority, which is a controller for all superannuation funds, mainly the institutional funds, because there are some other kinds of funds which I'll talk to you shortly about. It says $2.16 trillion, which is a little bit underestimation of the total superannuation money would be around $3.3 trillion. It is because not all funds are included in this amount, and there are some small funds, and many of them are not under the supervision of APRA. So, but these are mainly the institutional funds. And there are non-institutional small funds, which I'll talk to you about. So 66 MySuper products, again, these are default options, and then you have choice products. And as I said, that roughly now the choice products or the active choices, that money, more than $1 trillion, so exceeds slightly the default options. And you can see the defined benefits products are, the number of accounts is very small now, 0.7 million, as compared to 14.3 for default options and 7.5 for active options. But still considerable amount of $138 billion lying in the defined benefit, but over time that will obviously reduce. And within choice products, again, you have on the right-hand side, you have retirement products as well. So that many retirees would actually keep money with their superannuation fund in some kind of retirement products, which again, I will explain pretty shortly that what those are. And so average member account balance, and of course, this is average across all ages. So it includes young members and middle age and other members is in the choice accounts, 113K. But in the retirement accounts, you can see that the amount is $326,000. That's only for people who have money in the post-retirement accounts with the superannuation fund. So how the superannuation industry is organized, so fairly simple. Now you have, in Australia, we have corporate or public sector funds. These are funds which are offered by the employer to the employees. So the employer runs the fund themselves. These type of funds were pretty common in Australia, even before the superannuation guarantee legislation came into being in 1992. So some employers, and it was not compulsory at that time, but some employers did offer these kind of funds to their employees, and it as a kind of incentive for working with them. These kind of funds are now pretty much getting extinct, except public sector funds are still there, but the corporate funds are basically now has gone down in the number, as I'll show you shortly. So still 3.3 million members with $677 billion of assets. Next, you have the industry funds, which are the biggest funds in Australia. The industry funds are organized for people who work in a particular industry. For example, I work in higher education or university sector. So, and most of the employees in the university sector would be having UniSuper, which is the industry fund for the higher education sector with them. And then similarly, you have, funds for healthcare sector or retail or hospitality. And so these are organized based on industries. But very recently, due to change of legislation in Australia, they have been open for people from outside the industry, or any private individual can also open an account with an industry fund. So it's the name still exists as industry funds, but it's no longer the only exclusive for the members in the particular industry. They're pretty big in size, and these are not for-profit funds. They just charge you for the cost of the employees in the fund itself, rather than making any profits. As opposed to that, the retail funds in Australia are for-profit funds. So these are mainly run by banks and financial institutions, insurance companies. They have these retail funds. Then anybody can open an account with a retail fund, but mostly, as I said, that employees would be joining their industry fund. This is mostly you see the 6.3 million members in the retail funds. That would be probably a majority of them would be self-employed people, businesses, small businesses, business people who will be opening accounts with these kind of retail funds. For retail funds, obviously, the superannuation is, if you're a self-employed person, it's not kind of mandatory. So you are putting in money whenever you can and whatever you can. Of course, in the superannuation, whatever money goes in is taxed at a 15% flat, as opposed to the marginal tax rate for your other income. So there'll be an incentive for self-employed people to actually put money in, open an account with a superannuation fund, a retail fund, and put money in there when they can. And finally, so there are the small funds, which I was talking to before, that these are not regulated by APRA. The small funds are the funds which are mainly self-managed by the individual itself. Again, it's a very unique characteristic of Australia, I believe, that I can open my own superannuation fund and contribute to that. So, and it has grown in numbers a lot over the last 2 decades. So now there are 1.1 million people, and considering Australia's size of a country with 25 million, that's a lot of people who have just opened their own funds, and nearly the assets are nearly now getting close to $1 trillion in these kind of small funds. So if you look at the trends, it'll be clear soon. So, but these funds you can set up yourself and with your family members. Generally, it is, a lot of funds have 1 or 2 members, but you can go up to 6 members in a fund. So up to 6 people can set up their own fund. And why would you do that? Because probably, you'd like to have more control over your investments, or you don't want to pay the investment manager's fees. You think you can do that your own job, but sometimes they will be having their own financial advisors as well and set up their own fund. So now there are 610,000 of those funds, and as I said, that each will be having 1 or 2 members. That's the most common form, and they have more than 1 million people now in these kind of funds. And average assets per member is currently 780,000. So which is pretty much tells you the kind of demographic that will go for those kind of funds. So these are generally business people, or generally more wealthier kind of individuals who would be opening this their own funds and contributing to that. But obviously, as I said, that anybody can open this fund. Even if you're working for someone, you can open this fund and ask your employer to contribute to your the fund you have set up. So that's quite unique, I guess. Okay, so the trend in the fund, as I explained before, you see that there were 2,000 corporate funds in 2002. Now the number is only 12, because no employer is now interested to open their own fund and manage the assets for their employees, and so they have generally directed their own the funds to other retail funds or merged with some other funds. So these type of funds are getting pretty much extinct. Only 12 companies now run their own funds. Public sector is pretty much flat because, as you would expect, they are still running their own funds. There has been a decline in the number of retail funds and industry funds as well over the recent years, because there has been a significant trend towards consolidation through mergers of funds, and specifically to gain economy of scale. And that has led to a significant reduction in administrative fees charged to their members. So it has been a welcome development that we don't have too many funds now. But on the other hand, you have only few funds which actually have a majority of the assets in the industry. So as I said, it is a $3.3 trillion assets under management in superannuation now. The top 10 funds would be accounting for about $1 trillion or more in Australia. So so there has been a consolidation. On the other hand, you see this trend for self-managed funds. People who are managing their own money, that has grown, threefold in the last 20 years. So so that's the other trend which is visible. And in terms of the share of their assets, obviously corporates have reduced, as I said, because the number has gone down dramatically. Here, the only kind of funds which have more and more higher share of assets is industry funds, which has again jumped drastically from 10% in 2002 and to about 35% in 2022. So as I said, the biggest funds in Australia are the industry funds, and among the top 10 funds, you'll see 7 or 8 industry funds. So that's the general trend in superannuation. So coming to the fact that what happens after retirement with all the money you have accumulated, which is a kind of where the flexibility comes in Australian system, that it's no longer that kind of mandatory thing. So you have a lot of flexibility, but what do you do with your money? So for example, you can continue with your superannuation account, which you have currently before retirement. You can continue with that account after retirement as well, investing in any kind of investment options of your choice. And you can actually withdraw money as you require from that account. You still get, you cannot actually, you can put more money into that account as you did before retirement if you want. And the tax rates are the same. You'll be taxed 15% and 15% for all investment returns in that account as well. So that's a arrangement you can opt for, or you can withdraw your money lump sum from the superannuation. You can spend yourself according to some self-annuitization strategy you have, or you can spend the money whatever way you want. So you can withdraw as a lump sum as well. You can take out the whole money. On the other hand, many people also opt for something which is called account-based pension or allocated pension. That means you still have your money with a superannuation fund, but you now have a different kind of account, which is called the allocated pension account. So the difference between the allocated pension account and the normal superannuation account you had prior to retirement is in this account, you don't pay any taxes if you move into this allocated pension account. So that means any investment returns you're earning are free from taxes. Okay, but there's a trade-off. There is a mandated minimum drawdown. So you have to withdraw a certain amount of your portfolio value every year. So it starts from 4% after you reach 60 years of age from when you can actually withdraw, which is called the preservation age. And then it is scaled up. So after 65, it is 5%. After you reach 75 years, you have to withdraw 7% of your funds. And it goes up to 14% when you reach, if you're alive at 95, you have to withdraw that amount every year. So that is, you have a tax benefit, but you also have a mandatory amount of prescribed drawdown from that account. It's allocated pension. It's quite popular, actually. So you can still select the investment options your money would be. So a lot of people will be having, money in balanced funds and other kinds of funds in their retirement. Annuities have not been very popular in Australia. So there are only 1 or 2 companies which used to offer, and Challenger is the biggest annuity provider in Australia. But now many superannuation funds are also offering their own annuity products, which gives you a guaranteed income and till you live. So I would say the uptake is still very small. So about 4% of retirees would buy any kind of fixed income or guaranteed income products. Whereas, for account-based pension, I would say that number is close to 60, 70 or close to 70% people would be having a kind of account-based pension with their superannuation fund. That means that they are investing their money in some kind of investment options and going for that fixed drawdown every year as mandated. You can withdraw, of course, beyond the fixed drawdown amount. Okay, so so that means that if you have to withdraw, let's say 5% after you reach 65, and you keep your money in a balanced fund, which is roughly earning you, 7-8% in a good year, or most years it'll be about 7% on average, then you are basically, you're earning 7%, you're withdrawing 5%. So your accumulation, or you are accumulating more money even in your pension phase. And but sometimes it could be a problem because you have to withdraw next year more money if your fund has earned more, because you have to earn a certain draw down a certain percentage. For that, some people would actually move money again from account-based pension money to superannuation account, where there is no withdrawal requirements. So that's how the system is currently operating. So a brief look at the kind of account balance.
Hi, sorry, we've got a question from John.
Yeah.
Made can you have both self-managed and prescribed at the same time?
Yes, you can. So there is no restriction about the number of superannuation accounts a person can have.
Right. Okay.
In fact, many people do have more than one account, and it happened because previously people used to change job from one industry to another, and they will be having different accounts, in different funds. And sometimes they will even forget about the accounts they have. So now the government has changed the legislation a few years back that your account is pretty much stapled to you. So when you move from one industry to another, it doesn't matter. The new contributions will go to your old account unless you specifically ask your employer to put money in a different account. And similarly,
so that's a pot for life model. That's happening in Australia?
Yes, so it's a kind of portable model now, and you don't have to open a new account every time you change employers or move into a different industry as well. So in terms of the member accounts, the balances, you can see the balances are pretty much, when you're young, the balances are small, the average balances, and it basically peaks around 70, 75 years. These people. And these are only money in superannuation accounts with funds. Okay, so people may have money outside that as well, as I mentioned before. But you can see the 77 to 75-year-old people, they have the highest amount of money lying in the superannuation accounts at that time. So and that and remember that is actually going to go up in the future because a lot of these people who are now 70, 75 or 80-year-olds, they did not enjoy the full benefits of mandatory superannuation for a large part of their working life, because the mandatory superannuation only came into effect from 1992, and even then it was only 3% contribution. But now, as I mentioned, that since 2003, contribution has been 9%, and now it is going to be 12%. So many people who are, in their middle ages at the moment will be having far, far higher balances when they retire compared to what you see now in the superannuation accounts. So these are, the broad developments. So what has happened, as I said, that if your financial assets are higher, you don't get the age pension, so beyond those thresholds. And so 22% of retirees were not getting any age pension in 2000. So they were self-funded retirees, and now that number is it is much. It has almost doubled now in 2023. At the end of 2023, it is projected to be around 43% of people would not need any age pension. So because they have a very large part of accumulation in their account. This is the projection at the end of 2023. I don't expect it to be really 43%, but it will be somewhere getting close to 40% now. And so you have less people now drawing their age pension, and much less, in fact, getting the full age pension. Mostly, most people will be getting the part age pension. So so basically, that's a kind of, again, but the numbers could change. So you may not be eligible for age pension this year based on your assets, but if your investments have not done well, at a later time, or the market has not been kind, there's a market crash, and your assets can be will be reduced, and you may become eligible for age pension again next year, on a year or two. So that can change. Okay, so based on people's financial assets and incomes, and that analysis is done periodically. On the other interesting development is the reduction in gap between accumulation of men and women. So which was a big issue a couple of decades back, and I think I did some research on that as well. That because of career breaks of women with childbearing responsibilities, being employed in part-time jobs or in lower paid professions, the gap was pretty substantial, but it's a welcome change. Now we see that with generous parental leave provisions, and there are more incentives with now the childcare benefits have gone up, so there is women can get into the workforce much quickly rather than staying at home. So we have reduced the gap quite substantially. So overall, if you ask me, I think that if the stated goal of superannuation, which has been stated in 2014 as substituting the age pension or supplementing the income from age pension, I think it has by and large been very, very successful. And the current system has really served quite well with that objective in mind. And you have now, people who are drawing age pension, that number has come down substantially. And probably in 1997, 44% of people were getting the full age pension. And now that number is down to about 27%. Okay, the number of people getting part pension has, of course, increased because of stricter means testing. But obviously, overall, there's less pressure on the government budget about paying age pensions in future. So we don't have any kind of looming pension crisis in Australia where the government would be very worried about the age pension payments. In fact, age pension payments are currently about 2.7% of GDP, and it is projected to come down significantly in the coming 2 decades. I'll be surprised if it does not come down to about 2.2% of GDP. So overall, I think the system has worked well. And the other good point is because now less and less people are, or as a percentage, are claiming the full age pension or the part age pension, then the government can afford to be more generous with the Social Security payments for people who actually need it. So it is really serving its purpose as a safety net, and better than what it normally would, if a lot of people are actually claiming that. So that's a really a big plus, I guess. So what could actually upset this apple cart? So and again, it would be something like an economic shock. So if the government is forced to change the age pension provisions and who it provides, and changes the means testing any further, or is under the budget is under significant pressure from other areas, like there's a burgeoning cost of National Disability Insurance Scheme, which Australia has started in the last decade, and that cost is going up very fast. There are other demands from the childcare sector, from aged care sector. So for that, the government, if there's a huge budgetary constraints which forces the government to tinker with the age pension, who can get it, then perhaps it could be a problem. But and that's why I would strongly think that believe that people will still have to focus a lot on getting self-funded and focus on their accumulation. So the accumulation strategy, as I said, that has worked very well for people and in becoming financially secure in their retirement. So what can you do in becoming, in helping yourself to accumulate more? And I think, again, that what has worked is the forced nature of the mandatory nature of the contributions in Australia. So and which has gradually gone up over time to 12%, which is really has helped with this, people becoming self-funded. Now, if you look at the evolution of contributions, so obviously, the contributions are basically going up because of the cumulative nature, and also because people's salaries would increase from a young age to, middle ages. You have more salary, and as a percentage of salary, more contributions will be going into your account. So typically, it will pile up over time, and that is the kind of profile we would see in. So again, but now if I just look at the contributions plus returns, so it's not just the contributions are going up, and now you can see the full impact of contributions, which is the green line, which is growing up steadily because it's additive in nature. But I have also applying returns. So here in this case, I have just applied a time series of returns from the stock market on somebody's contributions. And I have taken 1972 to 2011, so typically a 40-year working life experience of someone, and that's what the blue line is. So when you apply that kind of returns on contributions, you scale much higher. But obviously returns can be different. So that is just one experience or one state of the world, 1972 to 2011. But you can have multiple states of the world in future. So that may not be the return experience of everyone. So for example, here I just reverse the sequence of returns. So I kept the same time series 1972 to 2011, but I just changed it from 2011 to 1972, the returns happening in that order. You'll get a different result. So obviously it will depend on the stock market or the market experience of people face. And it could be significantly different. And if you are experiencing, I've shown here in this graph 2 extreme scenarios for somebody in an accumulation phase. In one hand, I have just organized those returns from 1972 to 2011 from worst returns to best returns. So you have the poorest returns in the initial years and the best returns in the final years. And that is actually taking into an extreme situation for somebody who is starting with a $40,000 of salary, making a 9% contribution, and his salary growing at 4% per year. And if they have that kind of experience, the poorest returns first and the best returns later in that sequence, you scale up to $40 million, right? So, but that's not going to happen for everyone unless they're terribly lucky. On the other hand, if you're terribly unlucky with that kind of accumulation and you have the returns, the best returns first and the poorest returns coming prior to your retirement, then obviously the outcome is significantly different. You can see that the red line represents that kind of scenario. So which tells us something interesting in this graph, that all this difference, this blue line is actually lagging behind the red line up to prior to about 5 years before retirement. Okay, so in that case, so the final years before the retirement is really impactful to and what kind of returns you experience. So that's a kind of illustration I can show that if you have the best returns and the worst returns, it could be, but it could be somewhere in the middle as well. But the point I emphasize is the final years before the retirement is pretty important from your outcome perspective, and that's why asset allocation, how you allocate your assets in the final years, becomes really impactful for the overall accumulation outcome. And so in the investment strategies followed in Australia, historically has been more towards a diversified kind of investment strategy. Whereas in the US, what I see the most people now use a life cycle or a target date solution because they don't want to really suffer from a scenario where you have the red line or you have the bad returns in just before your retirement and your accumulation drops. So they generally follow the life cycle or the target date fund as a kind of solution. And most funds in US now have this as a default option. It is catching up in Australia, but and I believe it is also prevalent in UK as well. And so here you initially, as you know, you put more money in stocks when you're young, and you gradually cut down your exposure to the stock market as you get older and get close to retirement. So you start with about 90 to 100% in stocks, and then you cut down that to about, at the point of retirement, which is time 0, you get to about 50% or 60% in stock market. So that's the principle they follow, that you take less risk before your retirement. So on one hand, that makes sense. And this is what is the normal financial advice you'd get from advisors. But on the other hand, there is a problem with this strategy as well. And the problem is because of this. And this was first pointed out by Robert Shiller, Nobel laureate of 2013. And he wrote a paper in about 2008, which actually showed this problem. That a young person, having exposure to stock market about 90% sounds good. But when you're young, your contributions are very small as well, as you can see in the left-hand side. Very small contribution. So very small amount of money you're putting in the equity markets. And when your contributions are higher and the contributions are basically piling up, and plus the returns are also piling up, portfolio size is very big in the later years, you're moving into fixed income assets, which are actually earning a much lower return. So basically, in a dollar-weighted sense, your equity exposure over lifetime is very low. And that is resulting in a lower accumulation than you would normally have. So it is not really a very sensible strategy in most cases. And I have actually run thousands of simulations to show that in my paper published in Journal of Portfolio Management, that it is indeed a problem that if you do not contribute enough into equities in your earlier years, and as you can see that earlier years you cannot because your contributions are very small. So whether you contribute or you invest in equities 90% or 100% in the initial years really does not matter. Okay, what matters is what you are doing in the later years, because in later years your portfolio size is very, very high. So that is a problem with this kind of traditional life cycle strategies. So we actually proposed a solution, and I'll talk about this existing solution, and I'll also give you a few futuristic solutions of this problem. One we did which was called a dynamic life cycle glide path. So the life cycle glide path, as you saw in this, you saw in the previous slide, which actually had a deterministic kind of nature, moving from equities to fixed income. But in the dynamic life cycle glide path, we not only look at your age in actually or your years to retirement in changing your asset allocation, but we also look at how much you have accumulated with respect to a target you have set for yourself. So we have a specific retirement accumulation target, which is a compounded return target. And we see how the portfolio has done with respect to the compounded return. And if the portfolio is actually, so we initially follow the life cycle strategy, but if the portfolio falls behind in terms of accumulation at any point, we actually switch it back to equities. So we are not just moving unidirectionally from equities to bonds, but we have the option of actually moving from bonds to equities based on how the portfolio has performed over the years. So in our paper with Alistair Byrne, which some of you may know him in UK, and Michael Drew, we actually showed that this kind of dynamic life cycle glide path actually comes up with much better results than the traditional kind of life cycle strategy. So if you read the paper in our simulations, and I had an article in Financial Times as well about this, that the results for a DLC, which is the dynamic life cycle, is much better than the LC, of the life cycle strategy in terms of mean, median, 25th percentile, 75th percentile outcomes. And it has very little chance of underperforming a traditional life cycle strategy, in fact. And in fact, it has done, in terms of median outcome, it has done even better than the stock market if you invest 100% equities and a balanced fund as well. So visually, this is what is happening here. So if you think about this, these are all the accumulation outcomes. This is the cumulative distribution of the accumulation outcomes. The green line in the center is basically the accumulation target for you. And if the line intersects this target green line at a lower point, it's better, because that means you have a lower probability of falling short of the target. And in our simulations, and we ran many simulations here, the dynamic life cycle strategy is represented by the red line, which has a lower chance of falling short of the target compared to the other strategies like a balanced fund or a life cycle fund. So that is one solution we proposed, which actually used the target date funds philosophy of cutting down risk, but it also did it in a prudent way by combining the target debt with the target return kind of principle. So, but here are, I think, more fundamental ways of addressing the problem. Now, you see in this picture, I have changed the contribution profile. The main problem with life cycle strategy I have mentioned before is that you have very less contributions when you are young compared to when you are old, and that is why you have, the problem of getting exposed less number of dollars to equities at a young age. And that means you do not have enough accumulation in your middle and later ages, which forces you to be in the equity market for a very long time. And even the traditional life cycle strategies are 50 to 60% in equities before retirement, which is pretty high. So how can we actually change that? The only way to change that would be to actually increase the contributions when you are young. Okay, and in this contribution profile, which I have just, hypothetically I have put on the left, the contributions are, I have front loaded the contributions when you are young, and that means you're putting more dollars in equity markets when you are young, and then cutting short that exposure as you get old. So how can someone do that? Because young people don't have more income. So there are three different alternatives for doing this. So one is obviously borrowing the money and, for a young person and putting in equity markets. Although it may sound quite radical, actually it is not, because of course young people, 25-year-olds or 30-year-olds, buy their house, and which is getting a 30-year loan to buy a house. But they cannot do the same for equities, which is kind of strange because, if you look at a 30-year period, any 30-year or 40-year period in history, the stock market returns are far higher than property market returns. So borrowing is definitely an option. So but the financial institutions currently don't have that kind of loans for you to borrow for 30 years and buy equities. And if you do borrow money, you'll get margin calls because equity markets fluctuate from day to day and you'll get margin calls. So nobody will just, ignore that fact. So the borrowing, so it cannot be done through the normal commercial channels, I believe, at the current scenario is. So there could be some kind of borrowing at a lower rate from government or whoever, a government-funded organization, to invest in equities or growth assets when you are young. The other solution could be not a borrowing, but a matching contribution from the government. And at the moment in Australia, it's the employer is only making the compulsory contribution. Employees don't make contributions. It's optional. They can make contributions, but it's completely optional. And there is no matching contribution from the government. But if that happens, that's good. And I understand in UK there's a matching contribution, but you can think about, making a higher government matching contribution when a member is young, an employee is young. In the first 5 or 10 years of their employment life, if you put an extra 1 or 2% in their account, that actually had the power of compounding will take it at a much higher level in terms of their overall accumulation. So imagine somebody just putting in $500 every month when they're young. If you double that with another $500 or $1,200, that makes a huge difference over time with the power of compounding. The final solution is to use, get away from borrowing, but having that same kind of leverage using derivatives. And in this case, specifically, I will talk about call options. Options, as you would know, is where you can get into a contract of buying something at a later day at a price which is set today. So imagine a scenario where you can buy S&P 500 index fund or a FTSE index at today's level 20 or 30 years from now. To do that, you have to pay just a small option premium today. So you don't have to pay, you don't have to have the whole money to buy that in option markets. You just pay an option premium, and you get a much bigger exposure to the markets that way. The only problem is that you do not have a 20-year or 30-year or 40-year options in the market. So last month I was invited to the Chicago Board of Options to discuss this and talk to their product team. Currently, the options normally expire in 3, 6, 9, or 12 months. And they have some long expiry options, but that is only 3-year or 4 years options. So we were discussing the possibility of having a much longer expiry options, which could be used by younger people to build up their equity portfolio. In that way, you have a much higher exposure to the equity market in your younger years through that power of leverage. So you're not investing a small number of dollars. you can get exposed to a much higher level of equities. And that will actually help you to cut down your exposure to stock market much earlier prior to retirement than what currently is done by life cycle funds. So you're 50 to 60% in equities even before your retirement. But if you invest much aggressively using options in the younger years, and which will help you to actually cut down your risk much more aggressively in the later years. So you'll accumulate enough by your middle ages or in your middle years, and you can actually then drastically move into fixed income assets prior to retirement, and do not have to take that kind of risk to reach your accumulation goals. So we are progressing that discussion with SIBO, and fortunately, hopefully some kind of product development will take place in the future, which will enable younger investors to participate in the equity markets in a big way, because younger investors have the capacity to take that risk because they have a longer investment horizon compared to older investors, and the only thing that is holding them back is the lower amount of contributions in the younger age. So with that, I will end my presentation and hopefully leave you with some food for thought about the future of defined contribution plans, and happy to answer any questions.
Thank you very much indeed, Anup. That was a fantastic presentation. There's a lot of stuff going on in the chat. Perhaps we can ask John Mather. You put a lot of stuff in the chat. Do you want to ask your question regarding the tax system, John, or Chris, one of you? If you'd like to unmute.
Can you hear me? It's Chris.
Yeah, we can hear you. Yeah, hi, Chris.
Yeah, no, I mean, we simplistically talk about EET over here, don't we? Exempt on contributions, exempt on investment returns, and taxed on the way out when we draw the income. I just wondered in broad terms how that compares with the Aussie system overall.
Yeah, the Australian system is basically you are taxed in your way in, but it's a concessional rate of tax, which is you pay a flat 15%. And your investment returns are also taxed at 15%, as long as you're in the superannuation or the accumulation phase. And exit, you don't pay any taxes. So that's the system there. And when you move to the pension phase, you pay absolutely no tax. You can have money in the same kind of investment options you had prior to retirement, but you are not taxed at all. But you have to comply with the minimum drawdown requirements. So that's the only requirement you have in the pension phase in Australia.
So if I understand that correctly, that's TTE broadly, is it? But at quite low rate.
Yes. At least for the accumulation phase, it is TTE, yeah. And that T is a concessional rate of tax.
Right. What's the basic rate in Australia? The income tax?
The income tax rate is, yes, again, it is a progressive income tax, as most countries would have it, with the highest rates. I believe it is somewhere close to 40%. So or in the higher 30s, yeah. So it's no different, but obviously, and that is the attraction of superannuation, and that's why you have so much of private accounts, individuals, superannuation funds and self-managed funds, because of that concession. Of course, there is a cap on how much you can have that concessional tax rate. There is a cap on the contribution limits on that. After that, you basically, it becomes you pay your marginal tax rate on whatever you contribute to the superannuation account. And that is the case. Many employers actually offer you more than that mandatory superannuation contribution rate of 12% or 11% currently. So for example, in higher education sector, it is common to pay 17% superannuation. And so if you're somebody on a higher salary and getting 17% contributions, you are likely to exceed the concessional tax threshold at some point. And then you'll be charged the normal marginal tax rate for the excess contributions in that account.
Okay, thanks.
Yeah.
Thanks, Chris and Chris. We've got a hand raised by Stephen. Do you want to ask a question, Stephen?
Yeah, I'm fascinated by this comparison, but comparing what you're talking about in Australia with the UK, in that, I mean, we're still stuck, I think, in a mold of where we think essentially in defined benefit terms. I mean, we still have quite a lot of defined benefit schemes. We also have essentially a pension system, which is a glorified defined benefit scheme with a triple lock, where we're guaranteeing index pensions at a fixed level, throughout people's life, and they're everyone gets them. Whereas it's striking that you've essentially dispensed with both of those features of the UK system. And I'm curious, and trying to dispense with those with those components in the UK is enormously contentious. But somehow you've got away with it in Australia, but the counterpart to that presumably is, non-trivial risk in the decumulation phase. I mean, your investor here who's 50% in stocks, a big fall in the market would mean that the 5% compulsory drawdown is worth a lot less. So you have a lot more fluctuation in pension in retirement. Now, telling people in the UK in advance they're going to get that, there'd be an outcry. But I mean, what's happening in Australia today? Are people actually accepting that?
Yes, I mean, people are accepting that in a sense that if you observe the history of the markets, you have those kind of barriers. But, the recent history, I mean, by that I mean probably more than last 100 years, you'll see the equity markets generally have, give you better returns in 7 out of 10 years. And so, in a normal terms, in most years, your returns from your portfolio in the pension phase will actually exceed your minimum drawdown. And that way they're building up that arsenal. So yes, there was a drawdown, negative return last year, for example. The markets were not good, and typically a balanced fund in the pension phase portfolio, they lost 2.5% or 3% in that particular year. So, but that did not, will not spook you, because you have actually accumulated that kind of returns, and you're always going to fall back on that pension, the age pension, if your portfolio values gets significantly reduced, because once you fall below, $1 million of assets as a couple, financial assets, you'll be getting part pension, and the more substantial the fall is, the higher will be your age pension. So it's a kind of, a compensatory thing happening there with the age pension. So lower your income is from your portfolio, higher the age pension you get. In fact, I know a few couples anecdotally that, who actually blew up their superannuation money, and there could be a risk that they'd be too much aggressive in their retirement phase, because they always have that fallback option that they will get the age pension if everything, goes bad, and the age pension is kind of, it's reasonably good at this point, as I said, for a couple to get about $43,000 is not a trivial amount. So if everything goes bad, you always have that kind of insurance, and some people do engage in more risk than they would normally take by investing in the market, even in their retirement phase. And as long as the market is, giving you good returns in most years, you would probably not need that security anyway. So I think that is the thing. And interestingly, most Australians, actually retirees, die with a large sum of assets. In fact, 90% of all assets, and this I'm including also their home, is unspent when they die. So that is a study by Monash University done in 2015. So yes. So as such, it has not been seen as a problem. So unless something changes in this world and we have a completely different situation. So as things stand now, I think that security of age pension plays a big role as well. So if you really need to, fall back on that at some stage.
Okay, thanks. John, you put your hand up. John, do you want to ask a question or make a point?
Yeah, I was just thinking that what I've learned from today is that we should invest in the better economies. I mean, Britain is not the GDP per capita. If you look at those equations on the thing I posted, or the debt per capita, we have a problem in the UK. And certainly if we'd adopted this safe strategy prior to retirement last year, well, obviously it works till it doesn't work. It would have been disaster to move into gilts this time last year, wouldn't it? So, you know, we used to say to our clients that unit prices can fall as well as plummet. And that's what they did last year, just at the wrong time for people going into so-called safe. They weren't safe. So maybe we should think about the strength of the economy where we're putting the primary money to get the returns that you talk about. You're not going to get it in the UK. The FTSE has moved in the last 23 years from about 6.9 to what, 7.4, something like that. It's about 0.4% per year. That's tracking sideways to me. So it's going backwards when you take into account inflation, isn't it?
Yes, most Australian funds also have that kind of home bias of investing mostly in Australian securities, but that home bias has reduced over time. So now at least 50% or more of the assets are invested in overseas assets. And again, it is broadly diversified across different markets. So we are not particularly tied up to any particular market. And again, within that overseas investment, a large portion is also in emerging markets. So overall, by and large, if you look at the history of equity markets in the 20th century and beyond that, there could be a reasonable case for investing in equities for people who are investing for 30 years or 40 years. And that's why it is important for, as I was saying, that investment horizon is your friend when you're investing in risky assets, and younger people can actually have the capacity to ride up and down with the market, because whereas older people have less capacity to deal with that kind of situation. And similarly, younger people have a higher stock of human capital. So if you're having some investment losses, so you can probably have the capacity to compensate that by working higher number of hours or through your labor market outcomes. So and that's why it's important for people to invest in equities as early as possible, so that you take away some of that risk when you're getting to the point of your retirement pretty quickly.
Thanks, Anup. That's good. Michael, you got your hand raised. Do you want to ask a question? You can unmute.
Yeah. Yes. If we had a talk like yours was a very good talk. If we had a talk like yours, from a UK perspective, the regulator and what they do would appear. In your talk, there was no regulator at all doing anything. Would you like to have a word about that?
Yeah, I think, I don't know the situation very clearly in the UK, but I think you probably need a big kind of political will to do this. So in Australia, this was done by Paul Keating in the 1990s, this mandatory superannuation. I think that has really been a great success. And that time there were lots of opposition to that mandatory nature of superannuation. And as I said, that many people have criticized that the government to being too paternalistic in doing that. But once they actually forced that kind of superannuation and people saw the benefits, and that has actually again led to this gradual increase in the contribution rates over time. We started at 3%, now we are at 11% contribution rate, and people don't blink an eyelid when we see that that rate is going up to 12%. Some people are of course saying that it is too high, because we can see that retirees are retiring with a larger pot of money, and over time it will grow even larger, because lots of retirees who are currently working with the future generation of retirees would have that benefit of higher 10%, 12% contribution rates. And that has served them well. So obviously, there has to be this kind of grand vision, I think Paul Keating had, to provide a reform in the pension area. So it's a more of a political issue, I guess, in a sense, that you have to sell this kind of good political, good public policy through proper communication with the stakeholders.
But just so I understand, you were saying that contributions are mandatory by employers.
Yeah.
In our system, as I understand it, individuals can opt out. That's not the case in Australia.
Yeah, so you cannot opt out in Australia. So it is compulsory for everyone. So that is absolutely something which is very, very prescriptive. So that part is absolutely prescriptive. And I think that has really been a game changer in every way.
Thank you.
Thanks, Michael. John, you've got your hand raised, and probably one of the last questions, I guess, because we've overrun a little bit. But yeah, go on, John. Yeah.
I was just thinking that about this business of the age and the term. I mean, there's no reason. I mean, in my own case, what I do, I'm 76 soon, so I have actually 5 portfolios: a 5-year one, a 10-year one, a 15-year one, and a 20-year one. And therefore, I can have equities in my 20-year portfolio and feel very comfortable at 75, 76 years old. So I think it's not necessarily just one portfolio. And I think you said earlier, you can have as many of these funds as you like. So really timed portfolios to match your risk profile would be a thing to look at, possibly.
Absolutely. And as I said that, I don't see any reason for somebody at 75 not being in the market. I think, if you're in the market, in most years, you will do better than your drawdown requirements. In some years, yes, there will be a flow. And the portfolio values will go down. You have to accept that kind of. I think by and large, Australians are used to that kind of thinking in a sense that, and there's not much appetite for a secure income as such, as long as you have adequate assets. And that's why you don't have much appetite for annuity type of instruments. Even now, superannuation funds are offering that annuities. But as I said, that most people are basically dying with a large pot of money anyway. So it's not really a pressing problem to have a kind of guaranteed income. So as long as you have adequate income to look after yourself. And if you have a healthcare shock or something in later ages, that you have that huge accumulation pot, you can spend that money and you can fall back on the government age pension, which has also been pretty generous, given that now there are less people who are claiming that pension. So they have been able to increase that rate of age pension as well.
Thank you, Anoop. That's brilliant. Thank you. Well, I think we've overrun a little bit, but Anoop, that was a fantastic presentation. I think a lot of Pension Playpen members are flying off to Australia to join your system as soon as they can. It looks rather attractive in many ways. But yeah, fantastic presentation. Would you be happy to allow us to share the slides with anybody?
Oh, absolutely. So do you want me to send you my slides?
Yeah, send me the slides.
I will do that. Yeah, thank you so much. Okay. No worries.
So, number one, thanks, Anoop, for a fantastic presentation. Number two, thank you everybody for joining today. I hope you really enjoyed today's session. The video will be on the Pension Playpen site this afternoon. So really appreciate that. As usual, let's pray for peace in the East and peace in the Middle East. And we hope you have a really, really good week, and we'll see you next Tuesday, hopefully at our next event, where we think the pensions regulator, will be speaking on updating us on dashboards and DC retirement and value for money. So if any of you are interested in the pensions regulator, then they'll give us an update next Tuesday. So but Anoop, thank you very, very much indeed. I really, really appreciated that. Really, really good. And I hope you've enjoyed today's event, everybody. And if you're a member of Playpen, please share and invite friends. And if you're not a member of Playpen, please join. We'd love to have you on board. But yeah, lots of digital claps as well. You see, Adam, lots of digital claps.
Thank you so much. Thank you so much.
And time for you to go back to bed, I think. So.
No, I'm quite awake by now. So thank you very much. Time for coffee.
Yeah. Thank you very much indeed. Yeah. Okay. Thanks, everybody. Take care. Cheers. Bye.
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 Thank you.